Imagine waking up tomorrow and we strip Warren Buffett of his billions. No massive conglomerates, no special sweetheart deals, no infinite resources. Just poof. You hand him exactly $10,000 and you tell him, all right, start over. Build a portfolio for 2026 and beyond using only the knowledge you've racked up over 7 decades. So how would he actually do it? What exactly would he buy? Welcome to this explainer, where we're going to unpack this ultimate hypothetical wealth building strategy. Because look, here's the really incredible truth about this whole scenario. The underlying mechanics of building wealth, they literally do not change. The math, the intense discipline, that profound patience you need to turn thousands of dollars into an absolute fortune, it's the exact same set of principles used to manage billions. You really don't need a fancy Wall Street pedigree for this, you just need a plan. So here is our blueprint for today. We're going to cover the 5 rules, dive into the 4-part portfolio, discuss the anti-portfolio, touch on the psychology, and finally look at the math of compounding. All right, let's jump right into part 1, the 5 rules. I gotta warn you right up front, guys, without this philosophical foundation, the whole thing just falls apart. If you don't really grasp the why behind the what, you're inevitably going to abandon this exact strategy the very minute the market drops 30%, right? So here are your 5 absolutely non-negotiable rules for our $10,000 portfolio. Number 1, buy businesses, not stocks. You aren't just buying a blinking ticker symbol on a screen. You're buying fractional ownership of real cash flows, real products, and, real customers. 2, you've got to understand the business completely. If you can't explain how a company makes money in super simple terms, just skip it. 3, look for wide competitive moats. 4, buy at a reasonable price. And 5, think long-term. Actually, scratch that. Think forever. The ideal holding period here isn't a week or a quarter. It is forever. Let's actually pause and anchor that 3rd rule for a second, because this jargon is super crucial. An economic moat is exactly what it sounds like. Think about it. Just like a wide, deep water moat protects a medieval castle from invaders, right? A competitive advantage protects a business's profits from its competitors. The companies with the widest moats, they can predictably raise their prices, hold on to their profit margins, and just compound your wealth over decades without getting crushed by the competition. And that actually brings us to rule number 4, about price. This was a massive shift in mindset for Buffett. See, early on, he loved buying dirt cheap, struggling companies, what his mentor Ben Graham called cigar butts, where you get one last free puff before you just throw it away in the gutter. But his partner Charlie Munger taught him a totally vital lesson. It is far, far better to buy a wonderful business at a fair price than a fair business at a wonderful price. We're looking for absolute quality that compounds, not cheap businesses that just kind of exist. Okay, moving on to part 2. The 4-part portfolio. So let's look at exactly how we're going to allocate this capital. The strategy here is radical concentration. We're splitting that $10,000 into just 4 positions. We're talking 35% in a Vanguard S&P 500 index fund, 25% in Berkshire Hathaway, 20% in Apple, and 20% in Coca-Cola. Now you might be wondering, why only 4? Well, because when you're starting with just $10,000, owning 50 different stocks means transaction costs and fees are just going to eat your account alive. You really need focus. Let's break down the brilliant logic behind each of these allocations. First, $3,500 goes straight into the Vanguard S&P 500. This is your core foundation. It gives you this incredibly broad exposure to American business, including all those massive tech giants you really can't afford to buy individually right now. Plus, more importantly, it kind of protects you from yourself, from making stupid decisions. Next, $2,500 into Berkshire Hathaway. Think of this as a self-managing mutual fund sitting on a massive $150 billion cash pile. It pays 0 dividends, which means literally every single cent of their earnings is relentlessly reinvested for you. Then $2,000 into Apple. The moat here is their entire ecosystem. The switching costs to leave the iPhone, iPad, and Mac universe are just enormous, and that creates unmatched brand loyalty. Finally, $2,000 into Coca-Cola. Now, a boring beverage company? Sure, yes, but it has a 94% global brand recognition. It sells an affordable luxury, happiness in a bottle, basically, with remarkably stable demand through literally any economic cycle. Just look at these staggering stats to really build our case here. Apple generates roughly $100 billion in free cash flow every single year. I mean, that completely justifies its premium 30 times valuation. And Coca-Cola, get this, it has raised its dividend for 62 consecutive years. Through recessions, inflation, wars, Coca-Cola just keeps paying out. This is exactly why you hold these specific businesses.
Which brings us to the flip side in part 3, the anti-portfolio.
Because knowing what to buy, that's really only half the battle. Managing risk and knowing what to deliberately exclude is just as important. The totally crucial point here is drawing a very sharp, unforgiving line between investing and speculating. Investing is buying a productive asset that generates a reliable cash flow. Speculating, on the other hand, is buying something that produces absolutely nothing, simply hoping that someone else comes along later and pays you more for it than you did. One builds wealth, the other is literally just gambling. And that's exactly why day trading in cryptocurrencies have zero place in this blueprint. So because of that distinction, here is what is entirely excluded from our $10,000 blueprint. No individual banks. They're just way too opaque and highly leveraged. No speculative tech or AI companies with unproven business models. You just simply can't afford to speculate when you have limited capital. No individual pharma or biotech stocks, mostly because evaluating drug pipelines requires very specialized expertise. And definitely no energy or commodities, because they are highly, highly cyclical. But hey, don't worry about missing out. Your S&P 500 index fund gives you more than enough broad, safe exposure to all these sectors anyway. Let's move on to part 4, the psychology. Psychology really is the secret sauce here. You can have the perfect portfolio, but without the right investor temperament, you are never actually going to let this money grow over the decades. Consider this little test. Let's say it's next year, 2027. Artificial intelligence stocks are going absolutely crazy. Everyone you know is making money hand over fist on the latest fad, while your portfolio of Apple, Coke, and Berkshire is just quietly plodding along. The temptation to abandon your solid plan is going to be enormous. But the true test of a successful investor is having the patience and honestly the independence to stick to your quote-unquote boring strategy when everyone else seems to be getting rich quick. And what happens when the inevitable market crash finally comes? Well, if you've truly bought wonderful businesses at reasonable prices, a market crash is a buying opportunity. It's not a reason to panic. In fact, if you have automatic dividend reinvestment set up, a market crash is actively working in your favor. When prices fall, those steady Coca-Cola and Apple dividends, they're automatically buying you more shares, basically on sale. Finally, we get to part 5. The math of compounding. This is my favorite part of the explainer. Let's visualize the pure mathematical magic of setting up this disciplined portfolio and simply getting out of its way. Assuming a historical 10% annual return, which is historically very reasonable for these specific holdings, just look at this massive escalation. By year 10, your $10,000 has turned into $26,000. By year 30, it's $174,000. And by year 40, your single $10,000 investment explodes into over $450,000. But remember, this magic only happens if you don't interrupt it by panic selling. Now, let's introduce the one variable that you actually have complete control over, your savings rate. What happens to the math if, alongside leaving the portfolio completely alone, you live below your means and add just $200 a month to it? Boom! Over $1.4 million. Think about that. Starting with just $10,000, adding a modest $200 a month, reinvesting all your dividends, and then just waiting 40 years? That turns into life-changing wealth. No lottery tickets, no crazy speculation, just the single most powerful force in the universe doing all the heavy lifting for you. So I'm going to leave you with this final, somewhat provocative question. Are you patient enough? The blueprint is right here. Avoiding stupidity, staying incredibly disciplined, and letting time work its magic across a few truly wonderful businesses, that is absolutely the most reliable path to wealth. You don't need billions to start. You just need $10,000 and the temperament to actually see it through. So, which of those 4 companies are you